Right now, there's a good chance you or someone in your family is leaving money on the table every single month. Not because of bad planning, but because of one missing piece of paper. This isn't a loophole. It's not a trick. It's a legitimate federal document that, once approved, can increase a senior's monthly government income by as much as 40%. And here's the part that should concern you. The CRA doesn't call you to tell you about it. They don't send a letter. If you don't ask, you don't get it. Today, I'm going to show you exactly what this document is, what it's worth in real dollars, and the precise steps to get it approved. So stay with me, because point number 3 is where most people make the mistake that costs them thousands. Let's be calm and clear about this. We're talking about the Disability Tax Credit Certificate, Form T2201. Now, before you assume this doesn't apply to you or your parents, understand something important. This isn't just for people in wheelchairs or with visible conditions. It covers a wide range of conditions common in seniors: mobility limitations, vision loss, hearing loss, chronic pain conditions, cognitive impairment, and more. The CRA's own data shows the majority of eligible seniors never apply, simply because nobody explained it to them in plain terms. That's what we're fixing today. Let's address this immediately, because I know some of you are thinking is this a loophole? No. This is a benefit written directly into the Income Tax Act. The federal government created this credit specifically because it recognizes that certain health conditions create real financial strain. Applying for it isn't aggressive tax planning. It's simply claiming something you're legally entitled to. The only reason it feels like a secret is that awareness is low, not because it's hidden. What is it? The Disability Tax Credit, approved through Form T2201, is a non-refundable tax credit that reduces the amount of income tax you owe. But its real power isn't just the tax credit itself. It's that approval acts as a master key that unlocks several other benefits automatically. What is it worth? On its own, the federal DTC amount for 2026 is worth roughly $9,872, plus a supplement for those under 18. Combined with provincial credits, this can mean $1,500 to $2,500 back at tax time, sometimes retroactive up to 10 years, meaning some seniors receive lump sum back payments of $10,000, $15,000, even $20,000 in one check. How do they get it? Step 1. Download Form T2201 from the CRA website or ask your doctor's office for it directly. Step 2. Have a medical practitioner. This can be a doctor, nurse practitioner, optometrist, audiologist, physiotherapist, or psychologist, depending on the condition. Complete Part B, certifying how the condition restricts daily living. Step 3, submit it to the CRA, either through your CRA My Account portal or by mail. Processing typically takes 8 to 12 weeks. Once approved, the CRA will automatically reassess up to 10 previous tax years if you qualify during that time. This is one of the most common questions I get, and it's a fair one. The honest answer is this: your family doctor's job is to treat your health, not to track CRA tax credits. And many accountants only ask about the DTC if you specifically bring it up, because they're not always trained to identify who qualifies. This is a systems gap, not negligence. That's exactly why we're spelling it out here. What is it? Here's where the 40% figure comes in for many low to modest income seniors. Once the DTC is approved, it can trigger a reassessment of your net income for GIS, the Guaranteed Income Supplement. Because GIS is income tested, and because the DTC can reduce your reported net income in certain calculations tied to medical expense claims and income splitting, some seniors see a meaningful bump in their GIS entitlement. What is it worth? For a single senior, GIS can be worth over $1,000 a month. Even a modest reassessment adjustment can shift someone from a partial GIS payment into a higher tier. And for couples, the combined effect can be substantial. How do they get it? Once your DTC is approved, contact Service Canada directly at 1-800-277-9914 or update your information through your My Service Canada account and request a GIS reassessment referencing your new DTC approval. Make sure your most recent tax return reflects the DTC-related credits and any adjusted net income, since GIS recalculates annually based on your prior year's tax filing. I understand that hesitation completely, but consider this. This is a one-time application for something that pays out year after year and can be backdated up to a decade. That's not a small return on a few hours of paperwork. Stick with me, because point number 3 covers a mistake that causes even approved applicants to lose money. What is it? This is the point most people miss entirely. If the senior in question has a qualifying family member, a spouse, adult child, or other caregiver supporting them, DTC approval can also unlock the Canada Caregiver Credit, and in some cases, contributions matched through a Registered Disability Savings Plan, or RDSP, if the individual is under 60 at the time of opening it. What is it worth? The Canada Caregiver Credit can be worth up to several $1,000s annually to the supporting family member's tax return. For those who qualify for the RDSP, the federal government can match contributions up to 300%, plus a Canada Disability Savings Bond of up to $1,000 a year for lower-income individuals with no personal contribution required. How do they get it? For the Caregiver Credit, the supporting family member claims it directly on their own tax return using Schedule 5, referencing the DTC-approved individual's information. For the RDSP, visit any major bank or credit union that offers RDSPs, not all do, and bring the DTC approval letter, social insurance number, and identification to open the account. Fair question. The catch is simply friction, paperwork, unfamiliarity, and the mistaken belief that the process is only for people with severe, visible disabilities. That belief alone stops thousands of eligible seniors from ever applying. There's no hidden penalty, no downside to applying, and no cost to submit Form T-2201 itself. What is it? Many applications get rejected or delayed not because the person doesn't qualify, but because Part B of the form is filled out too vague. Doctors are busy, and if they write something generic like patient has mobility issues, the CRA may deny it. What is it worth? A denied claim means zero. No tax credit, no GIS bump, no caregiver amount, no RDSP matching. The financial cost of a vague form is the entire benefit we just walked through. How do they get it right? Before your appointment, write out specific, detailed notes about how the condition affects daily activities, walking, dressing, feeding, cognitive tasks, and bring them to your doctor to reference while completing Part B. Ask your doctor to be as specific as possible about frequency and severity. If denied, you have the right to formally object using the CRA's Notice of Objection process within 90 days. Don't assume a denial is final. To summarize, Form T-2201 isn't just a tax form. It's a gateway that can affect your tax credits, your GIS payments, caregiver support, and long-term savings matching through an RDSP. None of this requires a lawyer, an accountant, or special connections. It requires one form, one medical appointment, and the willingness to ask. If this helped you understand something the system doesn't explain clearly, let me know in the comments. Have you or a family member already gone through this process, or is this the first you're hearing of it? And if you found this valuable, there's another video that walks through exactly how GIS clawbacks work, which pairs directly with what we covered today.